Hey everyone, it's Henry, and in this video, I want to talk about covered calls, how they've made me a millionaire, and how you can consistently make income with the covered call strategy. Whether you have a small account, a medium account, or a large account, covered calls are literally the safest and most consistent way that you can make income with options. Now, I've been using this strategy for a very long time, and ever since I learned about this strategy from a famous financial advisor that I met back when I was a freshman in college, I fell in love with this strategy. And this strategy has really helped me make consistent growth. So in this video, my promise is that I'm going to show you how to open and enter into a covered call properly, how to manage the position once you're in it, and then actually how to close and completely profit on a weekly or a monthly basis using covered calls. And exactly, I'm also going to talk about the strike price and the expiration date. So you're in store for a masterclass on covered calls. So make sure that you're ready to take some notes. I'm going to show you lots of examples. As always, I appreciate you smashing the like button. You don't need to buy anything or subscribe to anything. I'm just here to educate you. All right, so the story is on how I learned covered calls is actually a financial advisor who was pretty famous. He was managing money for LeBron James and other NBA players. And when I had a consultation with him, basically it was a few finance students asking him questions, and we asked them, how do we grow a portfolio? What's the best way to manage money? How do you actually get good results? Because, well, you manage money for NBA players, so you must know, you must be really good at this. So the man was actually managing over $1 billion. And he told us it's very simple. The equation to gaining wealth with options is really simple if you can do covered calls properly. And I was like, well, what does covered calls properly mean? And basically he gave us a very long lecture, and I'm going to condense that lecture into today's video that's going to be much shorter, so you're going to get way more value. So let's go over an example right now. I'm going to give you the whole story as I go through the example. Let's use Apple because I currently have Apple as a covered call in my portfolio. The reason why you would want to do covered calls on things like Apple or Microsoft or Amazon is because a covered call strategy is a bullish strategy. At the end of the day, it's very simple. You have 100 shares of a stock, and then you sell a covered call collecting income on your stock. Basically, you're putting your stocks to work. You're telling them, hey, don't be lazy. Don't just pay me some dividends. I want you actually to produce me income, whether it's weekly or monthly. I'm going to go over two different examples. But essentially, a covered call, you're selling a call option and collecting premium on that position that you have, okay? So currently I have 1,200 shares of Apple. And as you can see, I actually have a covered call position. I just recently closed off a big winner in my Discord community, so I just opened this up today. If we go to my history, you'll actually see that I have opened this up just 3 hours ago and I rolled, okay? Previously, I actually bought back a 150 call for $44. I previously sold that for a lot more, so I made a really big profit. But, let's do step by step, okay? So let's take this example. Let's say that you have 100 shares of Apple, okay? $142 per share, okay? Mine is actually $145 average per share. Okay, you're gonna go to trade Apple options. And now, whatever your average cost is, if you buy it at this moment, you can sell a covered call that's just slightly out of the money. So for example, let's say that you bought 100 shares at $142. Now what you can do is you can go sell a call option and you can sell a little bit out of the money. So this is December 16. If you're watching this in the future, we could just go out like a month, but it doesn't really matter because the whole gist is wherever you buy a stock, you're selling a covered call that's slightly above the current price, okay? So for January 20, which is roughly 1 month out, I'm going to go ahead and actually sell the 150. So here, what you're going to notice is there's two components to this position. The first component is you have stock. So the stock can rise, and that's where you can see upside and actually make a gain on your stock. So if you bought for 142 and it goes up to 150, you can make like $8, right? That's $800. Now, if you sell the 150 strike, you can also collect $330 worth of premium. So this is a fantastic way into entering a covered call because, whatever price you buy it for, if you sell an out of the money option, you can only win. Either the stock goes up, you win on the stock, and you win on the covered call. The worst that can happen is you just sell it at 150, right? Now, another example of something bad that can happen, what scares people, but in actuality, it's much safer than owning stock, is say the stock goes down. Let's say that it goes down to 140, so you lost $2. Well, the thing is, as a stock investor, you lost $2. But as a covered call investor, you still lost $2, but actually you've collected $330. So although you've lost $2, you're basically collecting $3.30 per share. So you're actually going to be better off than the stock investor by selling a covered call. And that's because you have a margin of safety. When you collect this income, you can actually experience a little bit of a downside and still be okay. You can also experience the stock doing nothing and still profit by $330. Or even if the stock goes up to $150 per share, you still get that upside and you get your $330. That's why the financial advisor was telling us that covered calls are like literally the ultimate strategy to becoming a millionaire, and they're the most consistent way to grow your wealth. And that's actually the only strategy that he used for NBA players, which had me actually kind of scratching my head because, well, if this guy has a lot of experience, wouldn't he use every single strategy in the book? And that's kind of when I realized that you don't need to get really fancy with option trading to make a lot of money. If you keep it very simple, you can actually be very consistent. If you dial in your knowledge, you dial in how to pick the perfect expiration date, the perfect strike price based on fundamental and technical analysis, you can really kill it. And you don't have to get crazy with spreads or iron condors or Christmas trees. A simple covered call strategy done correctly can make you, as you can see here, $330, which is actually a 2% return in about a month. Not only do you get a 2% return in about a month, you also still have upside to the stock itself. So when you enter this position, you have an expectation that you can make upside about $8 in this position, which is over a 5% return in 1 month, and the premium itself is another 2% in a month. So this position right here, you can make about 7% returns in 1 month. Now that's a very high return on a consistent basis, and the reason why it's going to be tough is the stock is not always going to rise. But when it does, you can make a 7% return per month. When it goes sideways, you still collect a 2% return per month. And when you go down, well, you're still better off than the stock investor, right? We will still get affected by the market because this is a bullish strategy. So when the market goes down, you will still be affected. However, your total maximum profit is going to be much higher than just a stock investor in many different scenarios. And by the way I calculated my percentage upside was I just took this $330, I added it to the strike price, and as you can see, Robinhood already does the answer for us, which is $153.33. You take this number and you divide it by the current price of the shares, okay? So that's going to be the upside that you have. So another important factor that I like to look at when doing covered calls is momentum. If the stock is rising, then basically it is a very good candidate for doing a covered call. And basically when I was working on Wall Street, when I worked for Goldman Sachs and another hedge fund called PNC Capital Advisors in Philadelphia, I realized that a stock that has good momentum that's going up is likely to keep rising. That's like one of the biggest secrets is it's pretty simple. If you look at a chart and the stock is rising, it's likely to continue rising, okay? There's not that much more to that story. And the reason is because for whatever reason, we don't know why, but when a stock is rising, maybe it's insider purchases, maybe just because a lot of investors are becoming bullish on it. But for whatever reason, the stock is proven to continue going up. And for that reason, you want to use a covered call strategy. Because it's not like it's 100% going to rise up, but by using a covered call strategy, not only are you going to ride that momentum, but you're also creating yourself some income along the way. And speaking about covered calls and momentum, one software that I like to use is OptionsFi. I basically take a look at this software as a recommendation tool, and I use it to get some ideas. And lately, I've been doing a lot of covered calls on things like Apple and Google, and that's because I see it being recommended here, and it's been working out really well for me. Basically, it recommends an expiration date and it recommends a strike price as well. So let's check out this play right here on Apple 147 sell call for December 16th. So again, I'm going to go to Apple. December 16th is going to be a very short expiration day. That's going to be in just a few days. Again, if you're watching this in the future, short-term covered calls are still fantastic. Whether you go for 1 week, 2 weeks, or 4 weeks, that's still fine. The reason why you want to go a little bit shorter term is because options that are short term have a very high theta. Now, for me, I have sold a 146, but the software was recommending 147, which is really close to what I would have done anyways. So looking at the 147 strike, there's a few things that I really like to look out for, okay? This is exactly how you're going to enter into the option position pretty perfectly, okay? So the way to actually do it as perfect as possible is a delta of about 0.25 to 0.4, okay? It really depends. Now, why does it depend? A 0.25 delta is much better for volatile stocks. Since volatile stocks can move up and down a lot, for example, Tesla, you're gonna wanna go a little bit lower delta. And that's because a lower delta is going to be further out of the money. And the further out of the money the option is, well, you have more upside. But if a stock is not that volatile, for example, looking at Apple, it's only 49. That's not high, but it's also not low. That's somewhere in between. And that's why a zero point 0.3 delta is perfect. Because for a very volatile stock like Tesla, you might want to go further out of delta like 25, okay? For a medium stock like Apple, about 30 is fine. And then for a very low volatility stock like Coca-Cola, you might even want to go as high as a 40 delta. And that's because the stock isn't really moving that much, so you can go closer to the money. But for Apple, it's somewhere in between, and that's why a 30 delta is fantastic. So I'm going to delete this $150 call option for January, and I'm going to go just a few days out to 147. Here, as you can see, the premium is a lot lower. The reason why the premium is lower is because options have a lot of value from time. Here's the theta. The theta is 0.32, and what that means is for every single day, this option is losing about $32. But if you're an option seller, that's actually a good thing, because as this option decays $32, you are making $32 as the seller. You hope that this option doesn't explode and go up too much. Well, if it does, that's fine because you have the shares. You are covered. That's why it's called a covered call. Even if Apple went up to 150 or 160, well, that would be fine because you're protected because you have shares. But the one bad thing about covered calls is you will have to sell your shares at the strike price. And that's basically where management comes in. To be honest with you, I typically don't do any management. I just let the position expire on the very last day. And if this position is in the money, I will end up losing my shares. And if it's not in the money, well, that's a really big win for me because I've collected income. And even if the stock went down, I'm still better off than the stock investor. Now, covered calls are fantastic for consistency because basically, if the stock market moves sideways and you're doing covered calls, you're going to end up making good money. If the stock market goes up and you do covered calls, you're also making good money. And even if the stock market goes down, you have cushion and you still have income during the tough times. That's how I've been able to outperform the market this year. I have outperformed Kathy Wood and I've outperformed every single YouTuber. And that's because most people are buying hype stocks or really risky stocks. What I'm doing is I'm focusing on good growth stocks like Apple, Amazon, Microsoft, and all these other tech stocks, but I'm using covered calls on top of them, basically making my tech stock portfolio safer and generate income for me. Now, the more money you have, obviously you can snowball using covered calls and catapult yourself to becoming a millionaire very quickly. And then, obviously the more money you have, the easier it is just to make big numbers per month. But you don't have to start there. You can just start with $5,000 and you can use covered calls on things like, really cheap stocks like Hims or Oatly or whatever stocks are going for just a few dollars. A lot of stocks I do follow are somewhere in that $90 range. So it does take a little bit bigger of a portfolio. But if you look at Hims, it's only $7. So you only need $700, and then you can sell a covered call at like $8. And there you go. Your $700 can go to $800. And you could do that every single week. So if you have like 5 of these positions, then basically you can make $100 a day. So I would absolutely use covered calls as a main strategy for growing a small, medium, or large account. But if you're dealing with a really small account, then maybe you want to do poor man's covered calls. And I have a video that you have to watch if you want to grow a small portfolio right here.